Alright, so now let's go through a more complicated portfolio optimization with more risk assets. And for this, we're going to need a more powerful tool. So let's use Excel. The nice thing about Excel is that it's very visualizable, but of course you can do the same sort of thing in Python and any other sort of command-based programming language as well. So let's say that we have 5 risk assets now: Apple, BP, Citi, DuPont, and EA. We have their expected returns, perhaps from a forecast model using historical data. We have their variance-covariance matrix. Remember, now that we have so many risk assets, we actually have a lot of covariance terms on the off-diagonal, and of course on the diagonal we still have their individual variances. Let's say this is all monthly data, so they are not huge. We have a risk-free rate, which is also monthly, and we have some initial weights on each of them, and of course we want our weights to sum to 1, so let's make sure that that does happen. So currently our weights sum to 1 and everything is good. Now, if we want to create a portfolio of these 5 risk assets, as we've already specified sort of default weights here, we're going to want to come up with expressions for the expected return and the standard deviation of this portfolio. Now, how will we do that? Well, the expected return is going to be just that same linear combination of weights and expected returns of the individual assets, right? So we could literally say it's going to be the weight on the first asset times the return on the first asset plus the weight on the second, and so on. But that's a bit tedious, so instead let's just use linear algebra. Now, when it comes to portfolio management, linear algebra is sort of essential. So we can literally say we're just going to take the product of item by item, this vector times this vector. And for that, we can turn to a function that Excel has built in called SumProd. So all we need to do is just name our 2 vectors that we're going to multiply and add up, element by element. So we'll call our vector of weights here, as you can see, W_1. And we're going to call our vector of expected returns, as you can see here, ret. And in fact, you can name any cell in your Excel matrix anything you like. You know, we could call this cell Bob. There's no need for it, but that's just an illustration. Now, if we put in this command sum product of the 2 vectors, it'll do just that. It'll add them up and get us the expected return much faster. Now, when it comes to getting the portfolio standard deviation, well, we're definitely going to want a faster solution to that, because there's no way on earth you will want to watch me type out the item by item standard deviation of a 5-asset portfolio with 25 variance covariance terms. And frankly, I don't really want to do it either. But the good news is that we can again use linear algebra to do this very quickly. What we need to do is we need to, first of all, define our vector of weights. We already did, we called it W1. We can also name our variance covariance matrix. We did that, we'll call it VCOV. And now what we know from linear algebra is that the variance of a portfolio is just the weight of all the assets transposed times, in linear algebra terms, the variance covariance matrix times that vector again. So can we do this linear algebra multiplication in Excel? Well, the good news is we can, and the command we use for that is mmult. And here's how. So we're going to say 2 nested mmults, because we've got 2 nested matrix multiplications. We first are going to multiply the transposed vector times the variance-covariance matrix, and then we're going to multiply that result by the vector again. So here's where we do the first term. We're saying m mult of the transpose of the weight vector and the variance-covariance matrix, and then the m mult of that with the weight vector again. And we're going to take the square root just for good measure because we want the standard deviation rather than the variance. Now we have to enter this using Control-Shift-Enter because that's how Excel knows that we're doing a array multiplication. And there we have it. There is our portfolio standard deviation all in one fell swoop. Good. Now, let's actually sweep out our frontier of risky assets. Now we can do this one of two ways, remember. We can either, for every level of risk, pick the highest expected return, or for every level of return, pick the lowest risk. For computational reasons, since the frontier may have sort of the inefficient solutions as well as the efficient ones, it's better to just minimize standard deviation for each level of expected returns. So if our expected returns on the individual risk assets range from about 48 basis points to about 77 basis points, let's sweep out this range in expected returns. We know we can't really get any higher than our highest individual risk asset because we're not, well, we could if we allow shorting. But let's just sort of focus on the interior region. So how do we do that? Well, we can use the solver function in Excel. And here is what we're going to do. We're going to set our variance to the minimum. So here we've got our, well, portfolio standard deviation. I'm going to set that to the minimum. We're going to change the weights in our portfolio. That'll be our choice variables. We'll want a constraint that they sum to 1, of course. Because remember, it's going to want to try different combinations. We want to make sure that all of our assets are invested. And let's say that we want our expected return to be our first target. So the expected return on the portfolio should equal 50 basis points. Now, let's see if that works. So that's encouraging. It found a solution. Let's see what that solution is. It looks like for now it has actually been using non-negative. Let's actually let it short some assets. Now let's solve again. Okay, so now it actually wants to short BP, and it wants to take a big position in Citi, a smaller position in EA, really small positions in Apple and DuPont. And that gives us a standard deviation of 3.8%. So let's note that down, save it as a number so that it doesn't get changed later. And now let's go again. Now let's set our expected return to the next highest level of 5.5%. Let's solve that. Looks like we got another solution. And it is a little bit lower. Now let's go again. Set our expected return to 60 basis points. we're on a roll. We're getting solutions that are converging, which is never granted for the Excel solver. Let's go again. Now we're going to change our expected return to 65 basis points. Remember, we're always pasting these as values just because we don't want them to change later on, especially once we're running solver multiple times. Now let's set our expected return to 70 basis points. Solve that. And finally, let's set our expected return to the highest value of 76 basis points. And if we run that, we did hit it, and our standard deviation is 5.9%. Good. Now, did we actually sweep out what may be a reasonable minimum variance frontier? Well, let's actually look at that graphically. So here is our chart, and it looks like we did. You know, we've got a bit of an inefficient tail down here. We've got a long, efficient frontier up here. So that looks pretty good. Now, let's see if we're actually on the right track, and let's try to find the optimal risky portfolio. Now remember, when we say optimal, we usually think about the Sharpe ratio. So let's define the Sharpe ratio. Remember, that's going to be our expected return minus the risk-free rate divided by the portfolio standard deviation. All right, now we see we've got a Sharpe ratio of 0.1. Let's see if we can do better. So let's just optimize for that. Let's bring back our solver. So now instead of minimizing variance, let's maximize the Sharpe ratio. Set it to max. Still by changing those same weights, that isn't any different. We still want the weights to sum to 1. We don't actually need this constraint of expected returns anymore. So let's just have that. We found a solution, and it looks like it is indeed a better one with a Sharpe ratio of 0.117. So let's save that. Again, just by pasting as a number. And the two values that we got the expected return of 62 basis points. Let's save that. And we got a standard deviation of the portfolio of 4.2%. Now let's actually see where that would fit on our chart. Let's give it a name since we'll be spending some time with it. Good. Now let's add another series. So I'm going to call this one our optimal portfolio. This is going to have two values in it. Our x value, which is our standard deviation, and our y value, which is the return at that value. Now it's not showing up yet, but let's see if we can make it. We got a format. Our series for the optimal portfolio. We're going to give it a marker. The default is none, but let's put in a built-in. Let's make it this dot. Let's make it fairly big. And let's color it red so that it's noticeable. Okay, good. So this is encouraging, right? Our optimal portfolio is indeed on our efficient frontier, and it looks like it's at a place where we might well expect it to be tangent to our capital market, or yeah, I guess it would be a capital market line if these 5 assets comprise our market. But certainly the capital allocation line with the highest Sharpe ratio, given our interest rate. So by the way, let's draw that real quick. What would our capital allocation line look like? Well, we essentially need to just add a few points here. We can already use our optimal portfolio because we know it's going to go through that. We also know it's going to go through a point where standard deviation is 0 and the expected return is the risk-free rate, right? And then on the high end, well, let's say that we're going to just extrapolate forward. And let's say we'll take a standard deviation of 0.06. Now, what expected return should we get with that? Well, remember, the slope of the capital allocation line is the Sharpe ratio. So we can just take that Sharpe ratio that we calculated, multiply it by the standard deviation, and add our risk-free rate. Because we don't want the risk premium, we want the entire, the whole value, including the risk-free rate. So now let's add this to our plot. We'll call this the capital allocation line. Here are our x values. Here are our y values. And that looks pretty good too, right? It's, well, by design, going through our optimal risky portfolio, but it is tangent to our efficient frontier. Now, maybe the last thing is, let's actually go through a utility maximization to see where somebody's optimal portfolio would fall on this capital allocation line. Now remember, if you're on the capital allocation line, you're actually going to have the freedom to invest not just in the risky assets, but in the risk-free asset as well. So let's create a new set of weights. Let's call this weights 2. That is going to include the risk-free asset. Don't worry, our initial set of weights is still there. This is just a different array with one more element. And let's set up our utility maximization problem now. So first we're going to want to, again, add up all of our weights to make sure that they all add up to 1. Now we've got 6. For now, of course, they do. We just have implicitly 0 allocated to the risk-free asset. Now, what is our expected return? Well, that's going to be pretty similar to this previous one. Except now we're going to have a longer array of weights and a longer array of expected returns. So we already have our longer array of weights titled W2. Let's create a longer array of expected returns and call that RET2. And now both arrays will have the same dimensions, so they will multiply. If they don't, of course, Excel is going to complain. And again, since we have no allocation to the risk-free asset yet, the expected return to this 6 asset long weight of or vector of weights is the same as to the 5. Now what about our sigma, our standard deviation? Well, the good news is that that is actually going to be entirely the same, because the risk-free asset is uncorrelated with everything. Now, again, we're going to have to enter this as a Control-Shift-Enter command, but since whatever we put in the risk-free asset weight is not going to affect any variances or covariances, we can just use our variance covariance determined using these 5 risk asset weights. Now that we have our expected return and our standard deviation, well, we can actually create the utility function as, well, let's actually do one more step. Let's first figure out a coefficient of risk aversion. Let's start with a relatively high one, coefficient of risk aversion 4. Now, our utility function is going to be our expected return plus the risk-free rate minus 0.5, that coefficient of proportionality, times the coefficient of risk aversion, times the portfolio standard deviation. But remember, it's supposed to be a variance, so we'll just square. Okay, so now we've sort of set up the problem. We've got our weights that we're going to change, and we've got the outcome that we want to tie them to. So let's fire up the old solver again. So we're going to set our new objective, our utility function, to max. We're going to change this new array of weights. The constraint is going to be different because now we have a longer array of weights, but it still has to equal to 1. It looks like we don't really need any other constraints. All we want to do is just maximize our utility. So let's do that. And it looks like we found an answer, and actually this is an encouraging looking answer. Now, why am I saying that? Well, remember, we made this utility fairly risk-averse with a high coefficient of risk aversion, and we see that the optimal solution allocates a relatively large amount to the risk-free asset. Now, let's see where this falls, and let's hope that it falls on our capital allocation line. So here is our optimal solution with utility of 4. We have an expected return of 47 basis points, and we have a standard deviation of 2.9%. Now, let's go to our plot, and let's actually plot this optimal portfolio for this risk-averse investor on our plot of the capital allocation line. So this will be the optimal portfolio for investor with risk aversion 4. Their x value is the standard deviation. Their y value is the expected return. Now it's not showing up yet, but again, that's not surprising because we just need to display a marker. So let's go to marker. Let's make it, yeah, an orange square is good. And now you see that we are indeed on the right track because this does fall on the capital allocation line and it falls in the conservative region of it. We are investing about 30% of our portfolio in the risk-free asset. So now let's see what will happen if we make our investor less risk-averse. Let's give them risk aversion coefficient of 2. And now all we need to do is just rerun this optimization again. Looks like we found another solution. And this one's encouraging as well. See, now we're actually short the risk-free asset. In other words, with this lower risk aversion utility function, we're actually willing to borrow at the risk-free rate to put more money in the optimal risky portfolio. But now let's see where it actually lies. So with a risk aversion coefficient of 2, we have an expected return of 81 basis points. Indeed, it is higher. And of course, our risk is 5.8%, also higher. So now let's add this to our plot. Well, before we add a marker to it, let's actually add it to our series. So this will be the optimal portfolio for utility with coefficient risk aversion 2. Our x value is the standard deviation. Our y value is the expected return. Okay. And let's now add a marker for it. Let's use this rhombus. And indeed, the more risk-seeking, well, I wouldn't say risk-seeking, let's say less risk-averse utility function finds an optimum on the capital allocation line where you actually are short the risk-free asset and you're long the risky assets. So hopefully this wasn't too confusing. This is sort of a more nuanced application of portfolio optimization where we actually create a more realistic portfolio of optimal risk assets. We sweep out the entire mean variance frontier. We draw the capital allocation line through the minimum, or sorry, through the optimum, the optimal Sharpe Ratio risky portfolio, connected to the risk-free rate, and show that for different values of the coefficient of risk aversion, the optimal portfolio choice for the utility function will actually lie on this capital allocation. If you're less risk-loving, or I guess more risk-averse, you'll be in this region where you're actually in between the risk-free rate, or the risk-free asset, and the risky asset. You've got a positive allocation to both. And if you are more risk-seeking, or well, let's not say more risk-seeking, let's say just less risk-averse, then you'll be in this region where you are now borrowing at the risk-free rate. You're shorted. And that lets you take a position in the optimal risky portfolio that is greater than 1. So hopefully that makes sense. Thanks for listening. I'll see you next time.